Today's guest is Mr. Amit Jain, co-founder of Ashika Global Family Office Services. Amit has been a guest speaker on multiple international forums, and with him, he brings and shares deep insights about Indian as well as global markets. In this conversation, you are going to learn assets that are in bubble. Number two, how to find undervalued stocks. Number three, ninth wonder of the world, an investing philosophy that Amit preaches. And number four, how to go about selling your stocks, when to sell your stocks, and a lot more. These 38 minutes will give you a fresh and new perspective on investing. If you watch my content but have not yet subscribed, this is the time to hit the subscribe button because your subscription acts as a solid motivation. With that, enjoy this episode. Amit, thank you so much for giving me your time. Your office is, by the way, beautiful.
Thank you.
I just want to start this conversation on the bubbles that are building up in global economy, right?
Yeah.
Look at AI, look at Bitcoin, look at gold, look at silver, look at copper. Everything has given massive rally, right, across the global markets. Which, according to you, is a bubble and which is not a bubble? I mean, if you just can give me a broader sense and then we take it from there.
So I think most of the things at this moment of time, most of the asset class are under bubble.
Right.
Let me be very straight to you. One asset class, which we call India, looks undervalued to us at current valuations.
Right.
I'll give you an example. I'll give you some facts. For example, we talk about the private equity. We have a research team has found out 20 top startups from Europe, 20 top startups from US, 20 top startups from India.
Right.
In December 2021, when there was a peak for private equity, all 60 startups put together had a valuation of close to $700 billion.
Okay.
$700 billion. And their last round raise is close to $200 billion put together.
Right.
Which is a downfall of almost 70%. So this bubble is almost bust.
Right.
Now private equity, this bubble is already busted. One. Now the next bubble which we believe is going to bust is going to be a cryptocurrencies. They are already down almost 30% from their peak valuations. And I believe this asset class, as in cryptocurrency, has a further scope of going down. And that probably can create a global financial crisis 2.0 in near future.
Right. Right. If that's the case, then where are you bullish and where are you bearish as of now? Because it's very hard to be bullish on something right now because you see everything is run up.
Yeah. So when I said cryptocurrencies, it denotes somewhere US market. So we are bearish or extremely cautious on US stock market. On the contrary, at current levels, we believe Nifty and Indian stock market looks fairly valued to us. So we are cautiously optimistic on Indian stock market and structurally bearish on US stock market.
Okay. Okay. So you're talking about the valuations here, Amit. So what I want to understand is, in your definition, I know you guys do a lot of research across private equities and you're running family offices wealth, right? What defines the undervaluation? Because I think there's a lot of narratives in the market. How you look at an undervalued stock, whether you look at the P ratio and the traditional metrics. In your view, how do you define a business or an asset, whether it's undervalued or overvalued? Let's start from there.
Okay. So honestly, for us, undervalued means mispriced.
Okay.
I'll give you an example. Say at 1400 rupees, HDFC Bank was a mispriced stock. So we found it to be undervalued. Second example is Reliance Industries. At 1120 or at 1100, Reliance stock was undervalued because there was no change in the P&L of the stock. Probably the market for Reliance Industries was bad because someone was selling blindly.
Right.
We all know who was selling it, right? So we got that entry point. So within a gambit of stock market, you will always find some mispriced stocks within even Nifty 200 and Nifty 500 stocks. Because in India, there are more than 6,000 stocks which are listed.
Right.
Right?
Right.
The top 500 stock come in Nifty 500. Top 200 stock come in Nifty 200, right? Even in these stocks, which are the top companies of India, you will find a lot of mispriced stock at most of the times. As we share two examples, right? So what we always say is anything which is mispriced is undervalued. because fundamental doesn't change. Fundamentals did not deteriorate. It's only a price which has gone down because of some technical reason, not because of some fundamental reason. So they're undervalued for us.
So could I then, if we just take this argument further and say, let's say there is a stock ABC, and let's say earnings are growing steadily, quarter on quarter, year on year, 15% ka growth is, you can see that on the horizon. You can see it in the past, and the management is bullish about it. But for whatever reason, market has decided to have a sell rating on that particular stock, and the price drops. Would you say that because the fundamentals are strong, but for whatever reason market has discounted it, that's where the opportunities emerge, undervaluation?
Absolutely, you're bang on, Rahul.
Right, okay.
That's how the undervalued opportunities emerge, because the sell reason can be mostly because of technical reasons. Say example, Indian market is doing good. The P&L and balance sheet of the company is growing in. But suddenly there's a crash in US market.
Right.
Right? Do you think that the crash in US market is going to impact the P&L and balance sheet of Indian stock market? No.
Right.
It is mostly an emotional dampener for you. So we always say, when your stock is good, but market is bad, that's the best time to enter.
Right. Maybe, again, to my viewers, please don't take any of the stock names as recommendations here, but we're just trying to peel off the layers here, right? I want to just go to an example, and this is just fresh in my mind. Tata Motors passenger vehicles, right? The stock is down. Again, guys, this is not a recommendation, just a discussion point here.
Yeah.
Now, if you look at what's been happening there, their JLR in UK has been struggling. There was a cybercrime, and then there was incident happened there. And then the company has reduced the guidance as well, right? Their profitability. And in fact, the JLR unit made a loss in the just recently delivered quarter. Now, my question to you is, there are examples like that where you do see fundamentally a stock is now going through tough times.
True.
Right? Earnings, directly you can see the impact of earnings. Yeah. Management has gone very bearish. They're not giving the confidence. In such cases, would you say that these are undervalued because there may be recovery down the line? Or would you say, no, actually these are different. You're not talking about this. You're talking about mispricing where the fundamentals were good.
So we are talking about the second case.
Okay.
Where the stock P&L did not get impacted.
Right. Okay. I got you.
The management guidance is still bullish, but stock is down because there was some issue with the global stock market, or there was a crash in global stock market.
Right. Right.
So the fundamental of the company remained intact, or rather robust. Mm-hmm. But stock price is down because someone is selling because they have to cover up their loss in US by selling Indian equities.
Right. Okay. It's the opportunity that you can spot there.
Absolutely.
Okay. If that's the case, then Amit, I want to also understand then, now stock market is full of stocks. There's so many of the listed companies. Every year we are pouring 250 companies at least in IPO, right? And they're getting listed.
Yeah.
How do you then pinpoint, or how do you go ahead and say these are the undervalued stocks? Do you use a criteria to say, okay, these are my 5 filter criteria that I will look at to find out these mispriced stocks?
So honestly, there's one simple formula. Mm-hmm. If I can tell it to your audience, I think they will love it. Okay. Whenever you see that the profit of the company is growing more than 20% every year or 10% every year, the sales is growing by 10 or 20%, whatever criteria you decide in, but stock price has not grown more than 10% or a 20% criteria. So I can say so, whenever the stock price growth is lesser than the sales growth and the profit growth of the company, there are very high chances you are finding some good stock or a good entry point from the stock perspective, unless there is a fundamental change in the economic structure of the company or a broader macro of the economics. Example in Tata Motors you talked about, right? Yeah, we all know that Jaguar is struggling, right? They are having a stiff competition from the EV vehicle as well.
Right.
They're getting a tough competition from the Chinese EV vehicles, right? Not even they. Germany is facing a tough competition from the EV manufacturing from the China, right? So that's a structural shift which is happening in. Will not buy that.
Right.
On the contrary, if we find a company where the price of the stock has grown lesser than the PAT and the sales of top line CAGR, of course, a great opportunity, but you have to see the broader fundamental of the company and its operating structure, operating business model.
Right, right. Would you also consider other parameters when you're looking for undervalued opportunities? For example, you might say that, you know what, Rahul bhai, this company is generating good operational cash, for example, right? And they can invest this cash back into business. Maybe they can open another factory somewhere, right?
Yeah.
And therefore the earnings forecast might be, 2 years, 3 years down the line, their earnings might grow by, let's say, 22% versus their past where they were growing only at 15%. Therefore, the stock prices would eventually catch up to the earnings,
Yeah.
and those also become an opportunity. Would you say that?
Absolutely, yes. So in that case, rather than using P as a measure, we'll talk about the PAG ratio.
PEG ratio, okay.
So the PAG ratio is less than 1. It's a great opportunity because you understand PAG ratio.
PEG
right?
ratio.
All the
But for
audience,
our
I'm sure.
viewers, maybe you can just explain.
Okay, so PAG ratio is your P divided by growth rate. For example, the stock P is 20. But the potential growth of the company's top line and bottom line is more than 30. It means 20 divided by 30.
30.
You're
It's
getting
less
a
than
PAG
one.
ratio of 0.66.
So the price you're paying for the growth of the company is what you're looking at rather than the absolute price to earning multiples.
Absolutely, because
Okay.
then you'll find that if we only see the PE, you'll find the Coal India at a PE of 7.
I know
the growth-
RECs, PFCs, likes of those companies also
Absolutely,
have
I know.
very low
But the
PE.
growth is also limited.
Yeah.
So you have to see not only the P, you should always talk about the PEG. What price I'm paying for the growth of that company. If you really study it well and you can see that what capex plan company is having it, what management is talking about it, what is the growth potential of the industry and then the company. Of course, you can find out a lot of undervalued stock in the stock market today.
Right. And Amit, when it comes to different market caps, so we got large cap, we got mid cap, and we got small cap. Let's just focus to only top 500 and let's
Sure.
not go beyond 500. Would your definition of undervaluation change slightly between large cap, mid cap, and small cap, or would it still remain the same? Would you look at other additional parameters, for example, in small cap? Because we know small cap could be very volatile, and there is always a caution given to small caps.
So honestly, being a family office, right, we generally prefer anything between Nifty 200 to Nifty 500 because we need right allocation.
Okay.
Right? Because we have to deal with the larger chunk of investments, right? So definition broadly change when it comes to small cap and micro cap. Because what happened in most of the time, what people are facing nowadays is Nifty is at lifetime high or close to lifetime high. But the mid cap and small cap, specifically small cap and micro cap, portfolios are down by 20 to 25% in last 2 years. Right? So the definition change because in small cap companies and micro cap companies, fundamentals can change overnight. For example, the Trump has come up with the tariffs overnight. All the global facing businesses in small cap, micro cap has taken the beating overnight, but not the giant cap, right? Yeah. So that differs, but broadly the definition remains the same. However, it can be very specific to the company, whatever sector you are talking about. It can differ to sector and market cap to market cap.
Right. Okay. Fair enough. Since we touched upon the mid cap and small cap, there is another observation. So I keep looking at where the index was, let's say at COVID bottom. Okay. So mid cap, I was looking at that. From COVID bottom, it's now 400% up.
Yeah.
Small cap is almost similar, sort of. I don't know the exact numbers, somewhere similar. Do you think there is a value remaining still at index level, or you think there are only few pockets that from a valuation perspective we need to focus on as of now?
Honestly, in Indian market, we see a value in very few sectors now because we are bullish on Indian market for sure compared to NASDAQ. But in India, there are very few pockets which offer a value to you. Number one, today we feel IT sector gives a great value buy opportunity if you have a horizon of 3 to 5 years.
Right.
Because whatever headwinds you are facing in IT, they will settle down in next 1 to 2 years because we all know whatever tariffs or whatever threat Mr. Trump is showing it to us, they cannot sustain it in a longer run. Because without India, US cannot progress. That's what my belief is. Number one. Number two, FMCG sector, which is more domestic consumption. You're finding most of the FMCG's companies are trading at a valuation of COVID times. So that gives us a great value from an entry perspective with a lot of safety. So the risk reward ratio looks favorable in the FMCG sector. And the third one is PSUs.
Right.
PSUs are offering a great valuation. There are some stocks within the Nifty which you find from PSU offer a great value to us. So these three sectors give a great comfort to us to invest at current level. Although we are not outrightly buying it as of now because we are cautious on US stock market. And we all know when there's a cold in US, the whole world sneezes. Right. So if there's an impact in the US stock market, Indian stock market will also have a rub-off effect. So we'll start accumulating these stock in these sectors over a period of time in next 3 months.
You talked about PSUs.
Yeah.
So PSUs is a very big, broad theme. Within PSU, can I just ask you like which, I'm being cheeky here and trying to get into, is it the PSU banks you're looking at? Is it the defense you're looking at? Where are your eyes right now?
So 2 out of PSUs. Number 1, oil and gas.
Right.
Because oil is at is almost 3 years low as of now. Right. So oil, anything which is related to oil, when the oil goes up, if that stock price goes up, so mostly into downstream companies in oil, we are bullish on in PSUs. And second, we are bullish on insurance sectors.
Insurance, okay.
Insurance in PSUs, because if you see their balance sheet, P&L and growth, you will find a compelling buy valuation for the PSUs.
Right.
So within PSU, we are bullish on these 2 things.
Okay. Very, very good. Thank you for that. When it comes to undervalued stocks, since we're talking about the undervalued theme here, Amit, I wanted to check with you the soft signals. Because time and again, I have seen when I'm doing analysis of stocks, there are hard realities that are reflected in P&L or balance sheet or cash flows. So-and-so company is cash rich and so-and-so company is in heavy debt. But are there soft signals, right, that can indicate that there is a undervalued opportunity? It could be, it could be anything such as, brand value of the promoters, or it could be the code of conduct they follow. It could be the brand reputation that the company has built over a period of time. Or it could be anything which is more softer rather than numbers driven. And what are the softer signals that you look at, if you look at any?
So honestly, it is number 1, we go by numbers.
Sure.
So we have a 3-10 formula, 3-10% formula. We will not invest into any company which has a lesser ROE and ROC less than 10%.
Okay.
Number 1. Number 2, if the sales growth is less than 10% on an annualized basis, will not invest into that stock, because when India's nominal GDP growth is more than 12%,
Agreed.
11%.
So why would I invest in a company that is?
In a company?
But how back far do you go? Do you look at 3 years of sales?
3 years is a reasonable time.
Okay.
3 to 5 years is a reasonable time, and we can take out a median point out of it.
Okay, sure.
Right. It's a median point is a better rather than going for average.
Agreed.
Right. So we go for a median point and figure out if the sales growth is less than 10%, then you are not even beating the Indian growth story, which is 10 to 12% on nominal GDP growth rate. Right. And number 2, if your profit growth is less than 10%, then we'll not even look at that company.
Okay.
Right. So these are the elimination round for us.
Okay. Okay.
Number 1. Number 2, when we eliminate most of these companies, then we find out that which company is having a lesser PEG ratio, as we talked about.
Right.
Because PEG ratio, lower the PEG ratio, it gives us a great potential to buy. And of course, this is a quantitative side. On softer side, of course, the brand positioning, brand loyalty, repeat customer, promoter reputation, and how the governing bodies of India, the regulators like SEBI, like RBI, how they view that company, how the public image of that company is. These 5-6 factors come into the soft side of it.
Right. Since you touched upon promoters' brand strength and their image, I also wanted to check with you on pledging of the shares. We find companies that are good, they're growing, but then promoters have pledged their stakes and they're continuously increasing. I don't want to again name the stock here for obvious reasons, but do you invest in company that where the promoters have pledged their stakes or not? Or is there a percentage that you
There are more than 6,000 companies in India. We have to invest any point of time, not more than 20. We have better options, so we'll avoid these companies.
Even if there is 2%, 3% of pledging?
We generally avoid, because we have a lot of options. Stock market always works on relative attractiveness theory.
Right.
If I have something relatively more attractive, I'll move to that rather than sticking to a criteria.
Right.
So we'll avoid.
Okay, that's great. Time and again, I have found that I have spotted an undervalued stock. But after 12 months, I realized, oh, this was a value trap.
Yeah.
And just for the viewers' understanding, undervalued stock is the one that is hopefully going to give you some profits down the line. That's why you pick it up. But then value trap is where you think that the stock is so cheap that you buy it, end up buying it. But because the quality is not there, maybe there is a trap there, right? Because it is cheap. Do you guys separate, and how do you separate, more importantly, value trap versus, let's say, undervalued stock?
So honestly, if the PE is low for a stock, it doesn't mean it is cheap. Because the PE is low, then the market probably is reflecting a lesser growth for the stock. That can be a value trap for you, right? And there are very high chances that the retail investor get into that value trap. But however, the only one criteria we should keep in mind is the PEG ratio. If you are focusing on PEG ratio, you are getting a growth at a cheaper valuation.
Right.
Of course, there are very high chances you will not get into that value trap of it.
Okay. So, in order to avoid the value trap, do not just look at a low PE and say that this is a bargain opportunity. Look at the growth and then look at the PE. It's okay to pay slightly more PE for a growth that you're going for.
For a lesser PEG ratio.
Right.
So, at what rate you are buying the growth?
Okay, agreed. So, in that case, Amit, one thing that I also wanted to check with you, do you then, you don't invest in companies that are not having positive PAT? There are a lot of companies now, and I know there is so much of controversy right now. IPOs are coming up with, profitability just before the IPO. There have been, companies into food delivery where they have been showing negative earnings growth. Losses have been widening. They're still raising money and they're still getting the money out of the market. Do you keep away from those companies?
We keep away ourselves from those companies. As I said in the beginning of the interview, the top 20 companies, the startups in US, Europe and India, the valuations are down almost 70% in the last 4 years. And we have a hard-earned money, so we don't gamble around it. We take safe bets and we generally focus on risk-reward ratio rather than only focusing on growth or rewards.
Right.
We also want to cover the risk. And as a family office, it's our inherent duty to cover the risk first and then look for reward. So we avoid.
Okay, great. More often in the media, we hear rating agencies declaring, buy so-and-so stock. There is upside of 22%. I know you're laughing because it's coming all from experience and I can just resonate that, with you very well here. But just for my viewers, I really want this point to come out very clearly and I want to know your view. Whenever an analyst saying that, this stock is a buy or sell, whatever is the case, how much of weightage should you give to that? Should you listen to them? And there are cases where 5 or 7 of them have gang up, right? On a particular stock saying this is going to go up. Your views.
So as you said, I'll listen to them.
Okay.
And I only take it as a reference point. But I don't take their decisions for my portfolio management.
Right.
I just listen to them because I listened to 2 of them sometime back in say 2020 or 2023. I don't remember exact date when someone told me to sell Coal India at 180.
Right.
And then after that, Coal India has touched 520.
Massive rally.
Right. So I listened to him. I think not only I listened to him, I followed him. That was my mistake.
Right.
And second mistake I done when someone told me to sell SDFC AMC at 1800 around. And after that, we have seen 300% return on SDFC AMC. It is close to around 5800. Right. So after that, learning from my own mistake, I'm not following that mistake again. So I only take it as a reference point, but I don't take their decisions and their verdict.
Right. So I think these 2 mistakes, I can maybe, if you allow me, I can call them mistakes, and I have done thousands of those, still doing them, which is around, you sell the stocks pretty early. And there is a famous saying that, people end up watering their weeds, as you might have heard in the one up on the Wall Street book, and they cut their flowers. And that resonates well with me. I have sold stocks where they were doing pretty well, but then, greed kicked in and said, you know what, I've got 40% or 80% or 70%, whatever, money out of it, just sell it and just get out. How do you decide to sell a stock? What's your criteria?
It's difficult to sell a stock, I'll be very honest with you. First of all, we have to see that what is a broader macro environment. Say example, I'll try to break some myths which most of the investors has across the world. So first of all, the biggest myth is that अगर निफ्टी ऊपर जाएगा तो मेरा स्टॉक भी ऊपर जाएगा. इससे बड़ा मिथ हिंदुस्तान के अंदर नहीं है. नंबर 1 राहुल भाई. दूसरा एक मिथ है कि अगर जीडीपी की ग्रोथ होगी तो स्टॉक मार्केट की ग्रोथ भी होगी. ये भी एक मिथ है. we are lucky in India that हमारे यहाँ ये दोनों चीज़ें साथ साथ चल रही हैं. But चाइना के अंदर आप देखिए पिछले 10 साल में GDP डबल हुआ पर स्टॉक मार्केट 50% डाउन है.
Exactly, agreed.
Right? So what applicable in India? Because we have a comfort, we are non-aligned country. We don't favor US or China. We are politically well aligned. So I think the market and economy are doing in sync. Right? But it is not true for China. It is not true for Russia. Not true for most of the countries in the world. Right? So you first of all have to see the macro environment.
Okay.
If you bought a stock, you bought the stock when no one was talking about it. Good entry point. But when everyone on the street is talking about that stock, it's a time to exit. Because the stock market always run ahead of fundamentals. And it always run on stories. And stories generally create a hype in the market. That's what we have seen in last September 2024. When we decided to exit in a media interaction, probably when people were talking about 30,000 Nifty, we said, no, it will not happen.
Right.
Right.
There was a very good
euphoria.
time. There was a very good time to exit actually.
A lot of stocks you know which were at 800 that time, which probably we were talking about off the screen.
Yeah.
Today it is trading at 200.
Yeah.
Right. And probably you covered in one of their podcasts and your series, right?
Yeah, small cap stocks, some of those stocks are down by almost 80, 70%. And when they were down by 40, 50%, people were saying, you know what, it's 40, 50% down. Ab isse aur kya girega? But you know, stocks can go to zero. This is what I've learned. And there are practical examples that, again, for my viewers, if you have not read One Up on the Wall Street, please do read it. There are empty examples that Mr. Peter Lynch has shared in this book, where they say that just because a stock is down by 70%, don't think that the bottom is there. It can literally go down to 95%, 98% even.
Absolutely. You see Zoom stock and NASDAQ, you see NASDAQ 100, all 100 stocks are up? No. From last 4 years, there are 30% stocks in NASDAQ itself which are down more than 20%. And when the NASDAQ is lifetime high. So your index and stocks are related to an extent, not completely in and out. One. So we have to be very cautious what we are talking about it. And I think we have to figure out the opportunities. Whenever there's an opportunity for exit, we may, but you have to understand the macro environment first. If everyone, I'll come back to the point where we started from, that if everyone is talking about your stock in the market, it's a time to sell because there are very high chances there's a euphoria around.
Right, right.
So that's how we decide. So when we sell the market in September 2024, no one was talking about selling it. They were talking about 30,000 Nifty and we were exceptional that way. The kudos goes to my team for finding out that opportunity. So it all depends. Start from macro environment to micro level.
So can I just sum up your investing style? I mean, it's very hard to sum up anything, but the conversation we have had so far, it feels like your research team is, and your as a investor is looking towards more contra bets. You know, world is going gaga over, let's say, on one particular theme, but you guys are saying if that's happening, that's not where the opportunity is because it's all hyped and you rather look at something else. Is that, could I say that?
Absolutely.
Okay.
So honestly, you must have heard of the 8th wonder of the world called compounding.
We have.
A team and a family believe in the 9th wonder of the world. Okay. Have you heard of it?
No, what is it? Please enlighten me. 9th wonder of the world. I would love to know.
That is invest rightly, switch timely.
Okay.
Invest rightly, switch timely. If you don't switch timely, you will not make money. I'll give you an example. If in 1996, you have not moved from Europe to US, you wouldn't have made money.
Okay.
In 1996, the Europe stock market was trading at 35% premium to US stock market. So Europe was way ahead of US. This is Europe, this is US. It's a 35% premium versus US stock market because there was no tech stock.
Right.
In 1996.
Okay, of course.
And the tech sector has come and play. Tech has come. And then now, in 2025, when we decided our exit note, probably you've seen co-founder desk from my letter, which goes every year to every investor in the world, right? The US stock market was trading 35% premium to Europe market.
Right.
So in those 25 or 30 years, in 30 years, the Europe market, which was trading at 35% premium to US, is trading 35% discount.
Okay.
So if someone has not switched from Europe to US, they did not make money. Also, if someone has not switched out from Europe to India or Asia, they did not make money. That's the ninth wonder is all about. And it is not only applicable to the economies.
So do you intend to say that long-term investing is dead, given the current situation?
I think not dead, but the propensity to earn higher money at the propensity to earn higher compounding is going down with every year.
Right.
Right, because the world is coming into a debt trap across the world. Today, the global GDP, global economies are having a debt of $350 trillion versus a GDP of $120 trillion, which is almost 300% of debt to GDP ratio, which is alarming for the world. So because we have printed so much of money in last 50, 60 years, since the time the Bretton Woods and the Nixon 1971 we are aware of, right? We have printed so money. So the world is at the brink where there will be a reset of the entire fiat currency system.
Right.
So the propensity of making money by remain invested in a particular asset class or economy is going down with each year. Right?
That brings an interesting point here, that don't get attached to a particular theme for a long time. If you have to exit, you have to exit. So
everything has a cycle, honestly.
Right.
So I talked about the economy. Let me take an example. The Tata Steel and Tata Motors started in 1920s or 1930s. Tata Group has more than, say, 50 companies listed and unlisted put together, right? But Tata started TCS in the year 2000. Today, TCS on one side and all 50 entities on one side. Tata has switched timely from an asset-heavy business model called Tata Steel and Tata Motors to an asset-light business model called TCS. They switched timely, they made money. Even Reliance Industries has made money by making up Reliance Jio and Reliance Retail on their side. They have switched timely. So not only economies, everyone who is successful, whether it's a country, the way the US switched from asset-heavy business model to a tech, which is asset-light, they made money. Tata's made money from asset-heavy business model to asset-light model called TCS. Even a Sensex, if you see the 1985 Sensex and today's Sensex, 2025 Sensex, right? Only 7 stocks remain in the Sensex as intact.
Right.
Rest 23 are switch out. So if everyone is following that model called invest rightly, switch timely, how you can be passive?
Right.
You have to switch timely. That's what we say is the ninth wonder of the world.
That is excellent. This is something, a very new thought to me. Ninth wonder of the world. So I'll remember that one. Now coming to AI.
Yeah.
So I just wanted to know, you guys are doing a lot of research. You have a very big research team, in fact. What sort of AI tools, technologies are you using, and how you think the AI will reshape this entire research process? And how can retail people start using AI for research?
I think nowadays very easy. You need not to follow any research analyst.
Right.
You need not to go for any research reports. You can take it only as a reference point.
Okay.
But decision has to be yours because everything is so transparent. You can go on a screener. You can see the P&L and balance sheet of the company yourself. Why you need to go on someone else's decision?
Yeah.
So far as you are finding all the data yourself, there are a couple of good websites like Screener, trendline.com. You'll find out. You'll find out tijori.com for that matter, where you can get the entire market share and the business synopsis and model of the company. These 2-3 websites are good enough for a retail investor to study themselves and take their own decisions rather than following someone's advice.
Okay.
Because हमारा एक बहुत अच्छा हम लोग एक myth break किया है. Recently I have a podcast with my friend where I said कि अगर आप न्यूज़ पे काम करोगे तो आप न्यूज़ बन जाओगे.
Right. Okay.
So it's better you take your own decision rather than going for a news. You make your own decisions on that.
And I think this podcast definitely will help a lot of viewers on how to look at undervalued stocks and why it is important to look at valuations. Because as we started this podcast from the beginning, that gold, silver, copper, Bitcoin, NASDAQ, AI, everything is sort of in the bubble. This was beautiful so far. Totally loved it. I hope you guys are liking it. Let me now move to the rapid fire rounds.
Sure.
Amit ji, I'll ask you 5 or 6 rapid fire questions.
All yours, all
and I just want to take your instant reaction, right? Number 1, When will the Indian stock market see the next bull run?
Most likely in next 6 to 9 months. Once the US market AI bubble gets settled down, most likely in next 6 to 9 months, Indian market will start their next bull run.
Thanks for that encouragement and reading it badly now. So where do you see Nifty by 2030? Any predictions?
I generally don't predict much, but I believe a CAGR of 14% somewhere can take Nifty to 48,000 to 50,000 next 5 years.
By 2030, okay. Gold, massive rally so far. Do you think more is left?
For sure, but we entered gold. I don't know if you have seen my article called Gold is Next Bazooka. It was written on 7th July 2020 when gold was at around $1,400 an ounce. And from $1,400, it went to $4,200 an ounce, which is 300% return. But I think now we are a little cautious on gold because we believe that the majority of the rally has gone up. Now it will be more time correction and price correction in the gold. So we are still, we have decreased our allocation from 20% to 5%.
Because you made money.
We made money.
Okay. US stock market, so specifically NASDAQ, where do you see it by 2030? I know it's all-time high.
I know. So NASDAQ, to give you a factor around it, NASDAQ is trading at a PE of 33.
Which is historically very high.
Which is earning yield of less than 3%. Earning yield of less than 3%. And US government securities, which are the safest asset class in the world, presumed, they are giving you a return of 4.2%. So the riskiest asset class is giving you less than 3% in the world, and the safest asset class is giving you a return of 4.2%. So you have to figure out how this dichotomy is going to settle down in the next 6 to 9 months. Most likely, NASDAQ, we are extremely cautious at current levels.
Okay. Okay. AI stocks in US, do you think it's a bubble as of now, or do you think it's a serious wealth opportunity?
The serious wealth is already made.
Done.
I think now it's look like a more or less like a fair valuation. I'll not say still a bubble, but looks fairly valued. But we are cautiously bearish on US AI stock at current levels.
Okay, great. In India, let's come back to India. Large cap, mid cap, or small cap? Where do you think is going to be the next rally?
Small cap have corrected big time from their peak, from their lifetime highs, and even last 1 or 2 years. Small cap in very few pockets give a great opportunity. Also in very few stocks in large cap. So it's not going to be a broader rally for the market.
Okay.
It has to be going to be in a very few pockets. So the pockets we talk about IT, FMCG, and PSUs, and some small cap stocks. Even outside these categories can be a next great opportunity for making wealth.
Brilliant. Amit ji, thank you so much. This was very quick, powerful, a lot of insights. The ninth wonder of the world was something that I learned new today. And I think there were a lot of other things that I learned. So thank you so much for your time. I hope you guys enjoyed it. And I'll try and find out if there are any links. How do we get access to your articles that you publish?
So I think we have a website. I think we'll share the link with you.
Could you please? Yeah, I'll put it. And whenever you're issuing any new macro calls, definitely I would love to follow and see what's going on. So thank you so much once again.
Thank you, Rahul. Thank you. Pleasure is mine.